Okay, good afternoon. It's a great pleasure to welcome you to the panel discussion. My name is Marcel Rindisbacher. I'm the faculty director of the Mehrotra Institute for Business, Markets and Society, who kind of helps to sponsor this great event. It's a real pleasure to welcome Stephen Miran. He's a member of the Board of Governors of the Federal Reserve System. Previously, he served as chair of the White House Council of Economic Advisors and as senior advisor for economic policy at the U.S. Department of the Treasury. Before public service, Dr. Miran worked in financial markets and most recently served as senior strategist at Hudson Bay Capital Management and a senior fellow at the Manhattan Institute for Policy Research. He earned a BA in economics, philosophy, and mathematics here at Boston University and a PhD in economics from Harvard University. Joining him on the stage is Professor Hassan. He focuses in his research on international finance, macrofinance, and social factors in economic growth. He studies the effects of uncertainty on firm behavior and on the allocation of capital across countries and the effect of social structure on economic growth and the effect of historical migration and ethnic diversity on foreign direct investment. Professor Hassan's work has appeared in the top economics and finance journals. He's a research fellow at the National Bureau of Economic Research and the Center for Economic Policy Research. So it's a real pleasure to have both of you here. I think you know each other from before, and I'm really looking forward to this conversation. Thank you.
Yeah, thank you so much. So welcome. Welcome, Stephen. So we've actually not seen each other for 10 plus years. We were in grad school together. So this is also sort of a reunion for us. Adam was also in class with us.
But we both still have the same amount of hair as we did 10 years ago.
And some of Stephen's former professors are also in the audience. So one thing that Marcel didn't mention is you got the undergraduate prize for economics here. And your professors described you as a bright kid, thoughtful and inquisitive. You were also somewhat famous for lobbying that we really need an undergraduate course in the history of economic thought. Okay, so I hope you're all listening to this. So let me get straight into it. So I think the idea is that we chat a little bit, and then we're going to open it up for questions from the audience. So my first question, Stephen, what's your fondest memory from your time at BU?
So first of all, thank you all for coming out to chat with us today. Thank you for having me. It's a real honor and a privilege to be here. As you know, I went to college here, so it's really a particular thrill for me to be back. I suppose, I was just so happy with all of the really thoughtful people that I was really fortunate to engage with here. The faculty, but also my classmates, and I still have many very close friends from college from when I was undergrad here. I see them whenever I'm in a city that one of them is in. We chat all the time. So, it's a very great, it's a very fortunate place to meet lots of really interesting, inquisitive people and to just have those lifelong relationships that are blessing your whole life.
Yeah, I often say this in class, right? So one of the most important things you take away from this degree is the people sitting next to you, as opposed to what we say in the front. So before entering public service, you were making a lot of money, I guess, in the private sector. You had prominent positions in the financial industry where the financial rewards are obviously quite different from public service. Can you talk a little bit about what motivated you to step away from all that and take on senior roles in policy? So at the Treasury, at the Council of Economic Advisors, and now at the Fed Board.
Sure. So I'd always been interested in public policy and public service, and as an economist in graduate school, I specialized in public finance, right? Which is all about policy, and I found myself in the financial industry by accident. As I was finishing up my PhD and preparing to go on the job market, a friend of a friend reached out and said, I know somebody in a hedge fund that wants to hire a policy economist. Like, can they talk to you? And I had no idea what a hedge fund was at the time. It just happened. I thought they probably speculated in bushes or something. It just happened by accident, right? That was never my intention. So I'd always had this big interest in public policy. And then when the pandemic happened, what happened was I called a friend of mine in Treasury and said, this is the biggest economic policy support program in world history. You guys probably need a hand with the CARES Act and everything. And he said, yes, we do. And so I leaped at the opportunity to be able to jump into policy at the moment, and obviously worked in Treasury during the COVID recession in 2020. We just last night submitted did our as you know, as an academic, our second or third revision in our paper on the Paycheck Protection Program to the Journal of Finance last night. We submitted it because we're still, we have this proprietary data. We're still going through the evaluations of the Paycheck Protection Program, which I worked quite a bit on, and stayed involved in policy since then, and sort of obviously have had the good luck to be able to continue to be involved in something that I care so much about.
Yeah, so we have at least one editor of a top journal sitting somewhere here, so in case it doesn't work out in the Journal of Finance. So that's I guess, so the Council of Economic Advisors is the place in the White House where economic research and data are translated into policy. When you arrived there, can you describe a moment when you felt that really like your econ degree really helped with this? So economic analysis really shaped policy, and where the work that you and your colleagues did really mattered?
Sure. So let me just offer one small correction first, which is that economic analysis and modeling and data aren't translated into policy. They're translated into policy advice. I'm fond of telling people, or I was, and I guess remain fond of telling people, that it was the Council of Economic Advisors, not the Council of Economic Deciders. We give our advice, and people who make decisions, whether the president or cabinet secretaries, then go out and make the decisions based on, in part, on the analysis that we give them. There's a couple of areas that I would say I'm particularly proud of. One was the efforts to get the efforts on the full expensing front. If you look at the One Big Beautiful Bill Act, in my opinion, the more powerful provisions of it was the full expensing provisions, meaning you get to fully deduct from your corporate tax as a business what you invest on capital equipment, on structures, on R&D, which is a very powerful incentive for investing. And so in my mind, that'll sort of do a lot of work on stimulating investment in the United States in coming years. I think the evidence from the Tax Cuts and Jobs Act is that the full expensing provisions were the best bang for the buck in terms of incentivizing investment from the Tax Cuts and Jobs. When you look at the panoply of policies from the TCJA, in terms of efficacy. So there's a couple things that happened. One is we managed to get that to be a permanent policy instead of a temporary policy, which I think is really important for the long-run capital deepening of the United States. And two is that because of the intersection, and I think this is a point that's sort of still underappreciated, is the intersection of the full expensing provisions with the tariffs meant that it was a way of exempting most intermediates from the tariffs. Because if you pay the tariff on the intermediate and then you expense the cost of the intermediate on your tax return, there's a slight time delay, but at the end of the day, the tariff doesn't really apply to the intermediate good that you expense because you get it back. And so it was a way of actually making the policy a little bit better and from an economic perspective. And I think that was quite powerful. So I think there was a lot of good that was done. There's also a lot of other stuff. One of the other cool things about being, sort of in one of these positions, which to be clear, I'm no longer in. But one of the other cool things about being in these positions is the vast amount of stuff that you can't talk about, either because it's classified or it's national security stuff. But like there was a lot of really cool stuff going on supply chains. That continues, I think, to be really important, and I think that national security is going to continue to be an important driver of economic policy for a long time. Would be my expectation.
Okay, great. So, can you also share an example where, like, you gave advice and said advice was not heeded, or you really wish that it was?
Well, I don't know about really wish that it was, but one example of where I would have been wrong. Right, is when you look at the trade deals that were negotiated, ultimately they came with significant promises from other countries to make investments in the United States, or to buy certain amounts of goods and services from the United States, and I don't think I would have been a negotiator capable of getting those deals, right? So I probably would have given up earlier, and so that's an area where I think I was actually outdone by what actually happened on policy.
So can you so on that? when I talked about...
Sorry, to be clear, none of that has to do with the Federal Reserve. We're sort of speaking purely retrospectively on my previous existence.
Yeah, we should, whenever people from the Fed speak, there's a disclaimer that Stephen's talking about his own views and not the views of the Federal Reserve. I think one interesting thing, and I don't know if you want to comment on this or not, but sort of what I teach my students in class is that the trade deficit is equal to an investment surplus. So in some sense, the reason we have a trade deficit is because foreigners want to invest in the US more than Americans want to invest abroad. And one thing that I found very interesting during that period is that on the one hand, we were talking about reducing the trade deficit, and on the other hand, we were talking about raising foreign investment in the US. And that's just an equation. So it seems to me that that's a contradictory policy. Did you manage to explain that to someone at the White House?
Well, I think that there's distinctions between what type of investment you want, right? And so I think that everyone would accept a distinction between portfolio flows that sort of may just end up parked in financial assets versus flows that go into the real economy. And I think that difference is sometimes elided in the conversation. And when you look at the things that people focus on that they try and affect, I think there's often a very greater preference for flows that result in economic activity.
So for example, foreign direct investment as opposed to just buying treasuries.
Well, as opposed to portfolio flows, and I think you sort of see that as a result of some of the sort of when I look at, and again, this has nothing to do with the Federal Reserve, but I do think there's a bit of a distinction in that sort of comes out in some of the deals that occurred last year.
Okay, we've had a number of questions actually, so I'm condensing a bunch of them here about central bank independence. So particularly from some of our Latin American students. So can you just, as a governor, just say, why is central bank independence considered so important for controlling inflation and achieving economic growth?
Sure. So, central bank independence is going to lead to better policy. It's a means to an end, not the end in itself. What you want is to have monetary policy that's attuned to the business cycle. That's tight when the economy calls for tight policy and loose when the economy calls for loose policy. Not to have monetary policy that's attuned to a different calendar, say the political calendar or anything else, the sports calendar. You would want monetary policy to be tied purely to the economic cycle. Central bank independence is going to increase the likelihood that that's the case. And so, therefore, it's going to increase the likelihood that you get good economic policy, and it's going to increase the likelihood that you get good economic outcomes.
So you've written that the Fed is not as independent as people think, and that the boundary between independence and sort of policy dependence is a little blurred in practice. Can you explain that a little bit?
So look, I mean, the Fed, accountability for the Fed runs through the Congress. The chairman of the Federal Reserve testifies to Congress twice a year. Lots of people in the Federal Reserve have had experience in various branches of government. I myself was previously at the Council of Economic Advisors. We've got other people at the Fed who have been at the Council of Economic Advisors, who have been at the Treasury Department, who have been in other agencies of the government. And there's a lot of collaboration between the Fed and other parts of the government, particularly in times of a crisis. You get extensive collaboration between the Fed and the Treasury Department. And so it's not the case that the Fed exists in some totally, walled off silo, totally divorced from the world. There's a lot of information that comes to the Fed that affects the decisions that we make that come from outside the world, from the outside world. There's a lot of decisions that we make that are deeply integrated with what other agencies are doing, particularly in times of a crisis. So, there's no such thing as absolute 100% pure independence. Nevertheless, it is really important that we make decisions that we make for the economic cycle to be tight when the economy calls for tight and to be loose when the economy calls for loose, and for no other reason.
So normatively, do you think the Fed should be more or less insulated from policy? Just for the students in the room, one of the big reasons, and this is actually one of our advisors in grad school wrote the definitive papers on this. This is so one of the reasons we say as economists that kind of central bank independence is so important is because in many countries you see something that's called the political business cycle. So the political business cycle is when the central bank juices the economy right before an election so that people are happier. So back to you, Stephen. So do you think, just looking at the institutions that we have in the U.S. today, do you think that the U.S. central bank should be more or less insulated than it currently is, or is it just about right?
Well, look, I mean, I think that we're taking the decisions we're taking for reasons of economic analysis, and I have my own economic analysis, and I've been extremely forthright with my economic analysis and told people exactly why I have the policy positions that I have, whether it relates to the output gap, the neutral interest rate, the inflation outlook, and I think a lot of my colleagues have done the same. And obviously, we have disagreements over where policy should be at any given moment, but I think at the end of the day, people are taking decisions they're taking for economic reasons, not political reasons, and that's where it should be.
Okay, so in your, so can you just think about like in practice, so where's sort of a line that should not be crossed? So for someone who knows the politicians and also kind of goes to the Fed meetings, like, so where's the line that you draw?
Yeah, so look, I'm not going to comment on things that people who are not the Fed do, right? Like I'm not going to comment on any of the issues that are pursued by people who are not the Federal Reserve. Speaking purely for the Federal Reserve, I think that part of the thing that entitles us to independence is being seen as non-political and being seen as nonpartisan. And therefore, I think it's really important for us to keep as big a distance as we can from issues that are not monetary policy. What does that mean? I think that means from the Federal Reserve's perspective, I think it means not getting involved in climate politics, the way the Fed previously got involved in climate politics. I also think it means not getting involved in highly charged racial politics, the way the Fed previously got involved in highly charged racial politics. I can't comment on what other people who are not the Fed are doing. I don't make those decisions, right? But what I can comment on is what the Fed does, and I think that it's important for the Fed to continue to strive to be seen as being nonpartisan, as being seen as non-political, and stay away from any issue that's not monetary policy.
Okay, great. So on to an issue that's very close to both of our hearts. So you've argued that the dollar's role as the world's reserve currency is sometimes more of a burden than a privilege because it leaves the dollar persistently overvalued and contributes to trade deficits. Can you just explain sort of the mechanism? So what exactly links global demand for U.S. assets to weaker U.S. exports?
Sure. So I mean, first of all, I wouldn't say more of a burden. I would say that there's no doubt about it that sort of being and remaining the reserve currency is one of the best things in the world, right? And that's fantastic. Nevertheless, it is true that if people want our financial assets, the only way that they can get them is by selling us goods and services. And so there is, as you yourself before pointed out, there's a tight relationship between the financial account and the trade account. And then I think you sort of get into debates about which way does the causality run. And causality probably runs in both directions, right? But I think it's important to understand that it runs in both directions and not just one direction, as I think is sort of commonly assumed.
Great. So I think just on that point, so to explain this a little bit more to the audience. So the United States has been able to run persistent trade deficits for many decades in ways that other countries just can't. And so think of Argentina as really trying to run trade deficits all the time, and it's not working, right? So whereas the U.S. experience is very different. So we've had trade deficits for a very long time without triggering a currency crisis, without sudden stops, without a collapse of the dollar. So how is that fact connected to the dollar's role as a global reserve currency? I think that was sort of implicit to what you were saying, just to spell it out a little bit more.
Yeah, so as I was saying, we are the world's reserve currency, right? And we will forever remain the world's reserve currency. If we are going to be the reserve currency, we have to provide reserve assets to the world. And I don't mean purely for the official capacity. I mean sort of also, sort of the international role of the dollar and the international role of our debt markets. But the only way that other countries can get a hold of those assets is by selling us goods and services, by trading us something for them. If they're going to be if we're going to be net sellers of financial assets, then we'll be net importers of goods and services, right? And so as a result, there's going to be a relationship between the two that will persist for some time. So
many economists emphasize the benefits of the reserve currency status. So I guess we're all agreed on that. Arguing that sustained foreign demand for the dollar lowers U.S. borrowing costs. So typically the way that we quantify that is we estimate how much higher U.S. interest rates would be if the dollar weren't the reserve currency. And most estimates are around 1 percentage point, something like that. I might actually put it a little bit higher. But most people, I think in the profession, would say something about one percentage point lower interest rates for U.S. borrowers. So I do this kind of calculation in class. So the U.S. government, the different layers of it, have about $40 trillion in debt. If you 1% of that per year is $400 billion that you're saving, and now we can cut this in different ways, but essentially we're talking about a flow value just to the official sector in the U.S. of $400 billion. How do you weigh that against sort of other issues like overvaluation of the dollar? So how can we figure out like which one of these forces is bigger?
So I think in order to figure out which one of these forces is bigger is going to be an epic undertaking for economists, right? And I'm delighted to see that economists continue to grapple with this question. The research on the China shock has sort of grown and proliferated, and that continues to be underway. I have no doubt that being obviously being the reserve status of the United States is a crown jewel, right, in our country, right? And so it is something that obviously lowers interest rates and is an absolutely fantastic thing.
Okay, so just so you guys know, so China shock is, so the literature on the China shock is literature that's been looking at what happened after China entered the World Trade Organization and got better trading access to the United States. And essentially the result of that literature is that there are some places in the United States, very highly localized places where manufacturing shut down, and that led to persistent job losses. Whereas more generally, if you ask economists, is trade going to increase jobs or decrease jobs? They're typically going to say increase jobs, but there are sort of clear losers from trade with China, and that's what that literature on the China shock is about. So related to this, so U.S. government debt is high. So and many of us are worried that might at some point affect what the Federal Reserve can realistically do with interest rates. So the idea is if the government has $40 trillion in debt, and then the Fed believes, for business cycle reasons, we want to increase interest rates, that then the government has to pay more on its debt. So at what point should we worry that we get into this zone of what we call fiscal dominance, where the central bank feels like it can no longer move because a sovereign debt crisis might result from higher interest rates?
Sure. So before I answer that question directly, let me tie this a little bit back into what we were talking about a second ago. Normally when you think about reserve provision and you think about international sustainability, I think that it's important to understand that the net international investment position of the United States is $25 trillion, right? We owe the rest of the world $25 trillion more than we own of them, right? If that number became explosive to the upside, then I think you run into sort of positions of instability, right? Where you sort of then run into sort of these tail scenarios that economists don't really like to contemplate. I think that things have changed, and I think that and it's related to these questions of fiscal sustainability. It's related to questions of fiscal dominance and sort of where you get to borrowing so much that the interest expenses tend to dominate everything else. And part of the reason is because the government sector is the net borrower. When you look at the financial accounts of the United States, the corporate sector and the household sector are in moderate net financial surplus. It's the government sector that's net deficit, which means that that's the net swing both internationally and domestically. So when you think about net national savings, it's the government sector that's really the swing sector, and then it's the international sector, I think, that tends to respond on the surplus side. Although arguably you could say the household and corporate sectors do as well. The tariff revenue is substantial, right? And I think that goes a long way towards covering a lot of the various costs that we just discussed, as well as addressing a lot of the fiscal sort of fiscal issues. So the CBO thinks tariffs are going to raise at a decennial pace about $4 trillion, right? So that's about $400 billion a year of tariff revenue. That's also coincidentally the same number that you get if you boost GDP growth by a point, by 1% over a decade. It's about $400 billion a year. Now, GDP growth as a result of a variety of policies, as a result of, I think, what we were discussing before, the tax incentive for capital deepening in the One Big Beautiful Bill Act, as a result of what I view to be, quite aggressive changes to the regulatory landscape over the last 12 months that I expect to continue into the future. I think that these, as a result of some policies, as a result of a variety of these policies, I expect GDP growth to be maybe not quite a full point higher, but like close to, closer certainly to a full point than to a half a point. And so I think between the two of these things, you get pretty close to at least a couple of points of primary deficit reduction from those two things. As you know, interest expenses have been a large outlay as well. And so when I come and as the primary deficit comes down from those two things, I would expect the interest expense to come down as well. So between these three things, I'm a little bit less concerned about these issues that you're describing with fiscal dominance versus monetary dominance, fiscal sustainability, interest rates, long rates, as a result of these changes that have been enacted over the course of the last year. And I think they have material implications for the neutral interest rate of monetary policy, because the neutral rate is pinned down by the saving.
Let me interrupt you just briefly there, just to clarify. So are you saying that we are actually already more on the path of fiscal sustainability than we were a year ago?
I think so. I think that the tariff revenues are going to be significant in terms of reducing the primary deficit when you just make a forecast. And I think that the better GDP growth as a result of the One Big Beautiful Bill Act, as a result of AI as well, as a result of cutting regulations, I think that's also going to reduce the primary deficit. And I think that there's people who, there's well-known quantifications of the link between economic growth to primary deficits, because you get better revenues if you're growing faster.
Right. I just want to note that there is sort of like a disagreement there. So my understanding of what the Congressional Budget Office predicts is that we are actually kind of wandering still off the charts even after sort of factoring in the tariff revenue. But then, of course, there's a big open question, which is what are the effects going to be on economic growth? And I think you have a more positive outlook there than maybe what the Congressional Budget Office had in mind.
Well, I think that I think that they were under predicting the positive effects of some policies in the past, like the Tax Cuts and Jobs Act. I think I'm expecting some better growth from AI, and I'm also expecting some better growth from the changing regulatory apparatus, which I gave a speech on the effect of regulations for monetary policy about a month ago.
But the general thing is if we can. So the general thing is, if we can boost economic growth, then the budget deficit is not so much of a problem.
Well, the combination of revenue from tariffs and boosting economic growth will also boost revenues. And I think between the two of those, I think you're getting at least a couple of points worth of GDP of primary deficit reduction. With those couple of points, will bring with it reductions on the interest expense, bringing the overall deficit even further down. And so as a result, I view the overall sustainability outlook for these things as being materially better than it was a year ago.
Okay. All right. So somewhat related to the tariff revenue. So over the past year, tariffs that the United States charges on imports have massively increased. And there are ongoing trade disputes with several of our largest trading partners. What's kind of interesting is that whenever there's a threat of higher tariffs, the dollar depreciates. So we saw this basically on the day that the large tariffs were announced, beginning of last year. And we saw it again, actually, like just a couple of weeks ago when there was sort of an escalating trade conflict with the EU. So altogether, we're down about 10% over the past year. So the dollar depreciated significantly. Are you at all worried about the effects of tariffs on the dollar's role as the anchor and reserve currency?
No, I'm not. And as I said a moment ago, I think that the improved revenue outlook for the United States, which does really have monetary policy consequences through the neutral rate, through the supply of loanable funds, the supply-demand balance of loanable funds in the economy, I think that the revenue has really helped address has really helped improve the fiscal situation, which improves the longevity actually of the dollar's role as an anchor currency, as the dollar's role as a reserve currency. The best way, sort of to undermine that would be to have explosive borrowing, and I think steps that we take to increase revenues and reduce national borrowing actually improve the longevity of the system. And as I said before, if that international financial position exploded to infinity, that would more quickly than anything else eliminate the dollar's role as a reserve currency and as an anchor. So the fact that we've taken steps to improve the revenue outlook, to improve the fiscal outlook, have in my mind actually reinforced the role of the dollar as the anchor currency.
Economists hate budget deficits, as you can. So we're all on the same side here. Nobody likes them. I'm going to send you a paper of mine that kind of makes a direct link between the U.S.'s openness to trade and the dollar's stature as a world reserve currency. But we'll discuss that at dinner. How do you expect the weakening of the dollar and the ongoing trade disputes to affect inflation over the coming year?
So the pass-through of the dollar into consumer price inflation has been something that, it exists, but it's not one of the primary, when you think about what's first order, what's a primary determinant of the inflation rate. The dollar is something that matters, but you need a really big move for it to sort of really be a first order issue that would really affect consumer inflation in the United States. And I think that's less so in other countries where maybe they're not the reserve currency, they don't invoice in their own currency, they're more open economies, they have a much greater import share of the economy. And so when you get a currency move, it can pass through into consumer prices a lot more directly, or maybe they have more commodities in their consumption basket than we do, and fewer services. But the result is that it doesn't matter that much for consumer inflation unless you have a really, really big move in a really short period of time. And what we've had is pretty much a pretty modest garden variety currency move. I don't view it as something that sort of had material consequences for monetary policy thus far.
What about the tariffs?
Well, as I said before, I think the tariffs do have material consequences for monetary policy. I talked about this a few moments ago in quite detail in a speech I gave in September. What economists call the neutral rate of monetary policy is the rate, it's exactly what it sounds, neutral. It's not, you're neither hitting the gas nor the brake. Monetary policy is not affecting the economy. It's consistent with, what we would call the equilibrium balanced growth path, right? That neutral rate is a function of national borrowing, and to the extent that the tariffs have reduced national borrowing by raising significant revenues, then they will have suppressed the neutral rate in the economy. So I do think that there's a clear implication that tariffs require lower interest rates over time, and I think we'll end up seeing that.
So you've been in the room making monetary policy now. What surprised you?
So one thing that surprised me is, I kind of expected it to sort of be like a conversation. Like people would say, well, I think this, and then somebody else would say, okay, well, actually, you're missing this, and the other person would say, okay, well, you're missing this, and they'd go back and forth and have a conversation and get to a point where people, hashed it out. But that's not really how it works. Is people read, they write a statement, and then they read their statement, and there's not like really a volley of conversation and a debate that occurs through conversation. At the meeting, it's more like you read a statement and you're really preparing for the next meeting, right? The statement that you're reading is about the argument of the next meeting, because this meeting has already been decided. Everybody sort of arrived with their decision already made type of thing. So that's been one thing that surprised me. I think if you read the transcripts from the 90s, you see much more of a conversation. And so there's been some evolution of this over the years.
Interesting. You studied economics, math, and philosophy.
I was a math minor. I was a couple courses short of a major, and I didn't feel like killing myself in driving myself into the ground in senior year to get a third major.
And philosophy was also minor?
No, that was a major.
Okay.
Yeah.
How many majors?
2.
Okay. So it sounds like a lot. And you've moved between finance, policy, and public service. I have a point to make. So I often have students in my office hours who are very worried about, early admissions here and there, and like, what am I going to do in 15 years? What do you have to say about, what advice do you have for our students who are nervous about their path?
So, I think it's important to. So I'd give a couple pieces of advice. One is try and decide what you think a growth industry is going to be, and get involved in that growth industry. That's really important. Picking the right field can be important for the length of a career. Another thing is to make sure that you're also doing something that you really enjoy, because if you don't enjoy it, you're not going to be any good at it. And if you're not any good at it, there will be limits to how far you go. So choose something that you enjoy as well, because that's going to be something that will allow you to really get excited and learn a lot, and you'll be motivated to learn a lot more and become a lot deeper in your chosen subject. And the third thing is that things can become interesting as you learn more about them. And so if something seems like it's an interesting, viable career path and you think it's uninteresting, make sure you spend at least a couple days dealing with the subject matter before you decide that, because it could be that there's layers of complexity and depth that you're just not aware of. And so, and it's easier to do that now with the advent of AI and LLMs than it used to be. You can learn a lot about a subject by interrogating one of those. And so it is really important that you, for your own motivation, so that you excel, to be doing something that you really enjoy. But discovering what it is that you enjoy is a process. And so make sure that you invest energy to find that out.
Last question. One piece of advice that you would give your 20-year-old self sitting in a BU classroom. What do you wish that somebody told you at that point?
Go get experience, try stuff, right? I went straight from undergrad to grad school mostly because I couldn't fathom the idea of growing up and getting a real job. It just seemed like I can't do that. And I think that was, I think I should have gone out and experienced the world a little bit first. I think it would have eased learning on a lot of fronts later on had I had some actual knowledge of how the world works instead of just going straight from undergrad to grad school.
Stephen,
experience stuff.
Thank you so much. I think we're going to have a Q&A with the audience next, or Marcel? Yeah. Yeah, okay. So you guys can clap.
Thanks, Tarek.
Hi, I just have a quick question about, I know previously you have a paper and also a podcast episode, I think it's Macro Musings, where you talked about kind of your idea, this is obviously before you're in the position you're in now, about your kind of ideal framework or changes that could be made to the Federal Reserve. And I was kind of wondering, I think even from that paper and podcast, there are some things that you, I think, directly have even shown, like the idea of dissenting and more conversation in the Federal Reserve. But how has your perspective changed now that you are actually a part of the Federal Reserve?
Well, I mean, I think I've made it pretty clear that I have no problem dissenting. Look, I mean, I have a view. I think very deeply to try and make sure I understand things that I think I'm correct, and I think that the best thing that I can do is to just say what I think honestly and openly, and and just be honest and sincere about it. And I think eventually, if I'm right, if I hold my views for good reasons, then I'll turn out to be right, and eventually the world will come my direction. I think it is worth observing that I think the world has been coming in my direction on a number of issues. For instance, tariffs, right? Like a year ago, there were plenty of people who are much more well-known economists than I was, predicting recessions or inflation spikes worse than COVID. And I think very, very gradually over time, they've been moving in my direction, that the economic fallout of these actually has, I think, quite muted relative to what expectations were a year ago.
Can I also say that the tariffs are half the size that they were supposed to be?
So I hear that a lot, and let me make three observations in response to that. One, the tariffs are quite closer to what they were announced than they were in the status quo ante. Two,
so 17% is the average tariff on U.S. imports currently.
Yeah, and that's a lot closer to April 2nd than the status quo than they were on April 1st. Two, negotiation was always going to be part of it, right? And anybody who reasonably thought through the situation, could have predicted that. And three, a lot of the people who say that the tariffs are less than they were originally are also not people who ex ante would have predicted that you could have that constellation of tariffs and everything would be fine. So, I think, people only say, okay, well, they're not as bad as we are because they were reduced through negotiation. But if anybody who says that, if you'd asked them a year ago, could you get to a 70% effective tariff rate with minimal economic fallout, I think most of them would have said no, and I think they would have been wrong.
Yeah, I'm not sure. So again, one for dinner, but I think most people think it's about 1% of GDP that we have lower growth now. But I guess
economic growth has been pretty good the last couple of quarters, no?
We'll know. Well, there's always many effects, but we'll know in 6 years. It's like with Brexit, right? You have to wait 6 years to figure out who was right. Next question.
Thank you so much for being here, first of all. My question was regarding how the Fed, in pursuing its dual mandate, thinks about AI being such a large share of GDP growth, and also how that investment has maybe not, come to fruition in terms of returns yet.
Sure. So I think that there's no question about it that AI is having an effect on the economic data. I have a difficult time quantifying that. I think it's sort of in the investment data, it's a little bit easier because you see the fixed asset investment. At the same time, you see lots of imports that sort of counteract that, right? What's it doing to the labor market? I think is a little bit more of a challenge. You definitely hear stories about companies relying more on AI and less on new hires, which I think has definitely had an effect on the hiring rate and led to looser labor market conditions than I would like. And it's one of the many reasons that I think monetary policy is too tight. We've always had technological innovation. Technology has always eliminated some jobs, and it's always created new jobs as a result as well. And in my view, it's part of the monetary authority's responsibility is to accommodate that transition and not to keep policy tight to prevent the new jobs from being created. So it is something that enters into it. I have a hard time specifically quantifying AI because it is such a new and potentially radical technology. I have an easier time quantifying things that there's been abundant economic studies on. So for example, as I mentioned before, I gave the speech on regulations and monetary policy in January. That is an area where there's been some economic work, and so you can take some quantifications and say, okay, what has the regulatory change done to the inflation path? What has it done to the growth path?
Well, thank you for being here. So, I mean, you've written extensively about, and Secretary Besson has spoken extensively about the, kind of power of, currency offsets to kind of mitigate the inflationary impact of the tariffs. And, if that's the case, then I guess, simple extension of the logic would be that, consumers don't feel the inflation, so that they're not changing their spending patterns. So should we understand the tariffs as less of a reshoring play and more of just a way to finance the government for the burden of global public goods provision? Is there that reshoring potential, even if the inflationary impact is kind of muted by the offsets?
Right. So, as a member of the Fed board, I can't really speak to what the goals of the tariffs are in my current capacity. However, what I can say is that look, as Tarek pointed out, the dollar has not responded the way to this round of tariffs that it did to the 2018-2019 tariffs. I think there's some potential explanations. One of them is that it was all priced in ahead of time because everybody thought there was going to be these radical, the president said on the campaign trail, he said 50 to 60% on China and 10 to 20% on the entire world, right? And that's ballpark of where we are, right? So it is possible that a lot of that was priced in ahead of time, particularly with the experience of 2018-2019. But the currency is only one channel that you can, for me, ultimately, as a public finance economist, this is an incidence question, right? And economists know that the burden of a tax, a tariff, a subsidy, any economic policy is ultimately borne by the more inelastic party, right? That's a basic result of tax instance theory in economics. For people who are not economic specialists, you can think of it as the more inflexible party. The question in my mind is then, is the U.S. the more flexible or inflexible party? And I think that we're the only very large source of of consumer demand in the world, whereas there's lots of countries that want to be sources of supply. And so that probably makes us more elastic, gives us more bargaining power, and it gives us the ability to shuffle supply chains across countries, which then makes them inelastic producers and allows us to force more of the incidence onto the exporting country. The currency is one channel through which that could happen. It happened last time, I think, through that channel. But it also could happen through nominal price reductions, through countries just being forced to cut their prices because of the tariffs. When you look at the elasticities in the literature, and I gave a speech in December in the Inflation Outlook where I went through these elasticities and I give a lot of analysis on a lot of elaboration on the incident story. I believe that ultimately most of the incidents will be forced upon the exporter and not on the importer, which means that it's revenue that's ultimately borne, the burden of which is ultimately borne by the exporter. Now, when I look at the inflation data, I still, despite many people who disagree with me, I still do not see material evidence that tariffs have had a strong inflationary consequence. What do I do to arrive at that conclusion? I look at the price of overall core goods in the United States versus imported core goods, and there's not much of a difference. And I would expect imported core goods to be inflating at a much higher rate than overall core goods. I look at U.S. core goods inflation versus core goods in other countries, and I would expect to be able to look at that chart and pick the U.S. out of a lineup, right? Without labels, I would think that if you looked at core goods inflation across countries, you should be able to pick out the U.S. Without labels, if you think that tariffs are a material driver of inflation, and I can't do that. So those comparisons make me think that there's not a lot of tariffs in the inflation data in the United States. Now, that may yet change, right? Like if those analyses, at the next inflation print, show that you can pick the U.S. out of a lineup, or that you can clearly identify imported core goods versus overall core goods, I'll change my mind and I'll say that there's some evidence of tariff inflation. But right now, I don't see it, and so then you're left with the question of what is driving core goods inflation in the United States, which is higher than it was pre-COVID. And I don't have a really good answer. I don't have a great answer there. I think there's some possibilities. One is it's just these continued post-pandemic bullwhips like we've had in the previous few years that could still be going on. Another is it could be related to fractures in the global trading system that long predate last year's tariffs, right? If you think about it, during the pandemic, we couldn't get, sort of medical equipment, and that led to people refocusing on supply chain security and supply chain resilience. And then there's been sanctions and export controls, and you can't sell semiconductors, and you can't sell rare earths, and this stuff has been going on for years, even since before the pandemic, right? And these are very long-term trends that have been there for a while. And so I think it's facile, and I think it's too convenient for people to sort of say, oh, well, inflation is too high because of tariffs. I think that's a bit of a lazy conclusion, and it may yet be the case that we get evidence in the data that may lead me to say, look, I see some small tariff inflation, right? But I don't see it yet.
Can I just, because this went very fast, I just want to clarify a few things. So by the exchange rate went the other way, what we mean is that essentially the textbook would say, if you're a country and you make a tariff on everyone, your currency should appreciate and undo the tariff. That did not happen. Instead, the dollar went down, which freaked out a couple of people, including myself, about the reserve currency and so forth. And it's a little unclear what that means. The other thing that happened is that, so if you look at prices at the dock, so how much is the US importer paying for the imported product, the pass-through of the tariff into that is apparently 1. So there's papers coming out now that looked at this, and it is true. So, let me just finish one sentence. It is true that the US importer is paying the tariff. Now, what Stephen's pointing out is that it's not showing up in the inflation numbers as much as you might have thought, and that is mainly because the importers seem to be absorbing this into their have lower profit, which, as an economist, you might say that's great. Lower markups is also a good thing. But that's essentially, those are the various things going on. Was that?
No, but I think there's an identification problem. There's an empirical problem in your conclusion that, because I've seen this argument too, that the importers are absorbing the burden, and just because the importer is domiciled in the United States does not make it a United States entity. And so, for example, if I'm a auto importer and I have let's call me XYZ Auto Import, and I'm buying autos from XYZ Autos in Europe or Asia, right? And my U.S. subsidiary of XYZ Autos is buying from XYZ Autos Europe or Asia. My U.S. subsidiary pays the tariff as it imports from the from the parent company in Europe or Asia. In those data, it looks like a U.S. entity is bearing the burden, but it's actually just the U.S. subsidiary of a foreign company. So I think it's entirely inappropriate to say that we can conclude from those data that U.S. agents are bearing the burden of the tariff, because some of those companies are actually subsidiaries of foreign companies. And whether the incidence is borne at the U.S. subsidiary level and then passed up through lower profit margins to the parent abroad, or whether the incidence is born from the parent company lowering their selling prices, economically shouldn't matter. So I don't think we can conclude that from those data.
Yeah, so just to clarify, there's a literature on this, and that might be a twist that I think they might not have thought about. I have a paper here by Geeta Gopinath.
Yeah, that's the paper that I'm talking
and
about.
Brent Nyman.
Yeah.
So just to be clear, these are very prominent economists.
And their previous research I take issue with as well, because their previous issue on the first trade war, they compared imports from China, right, to other imports, but they couldn't figure out transshipment because there was an incentive created to transship goods from China through other routes. And so that led to...
I get your point. So
all I'm saying is those papers, respectfully, wouldn't make it out of a labor seminar, right? And so I think there's identification problems, and I think we can't conclude from those that the incidence is borne by Americans.
Respectfully, it's published in the American Economic Review in 2019, so I'm not sure. Not 2019, 2021.
I think there's identification problems that have led people to make erroneous conclusions about tariffs.
Okay. But that's a question for this literature, and we'll certainly keep that in mind. Do we have more questions? Adam.
Yeah, so I wanted to ask about the balance sheet, which has been a hot topic in the last few weeks since the next Fed chair was nominated. It strikes me that some of these arguments are about the appropriateness of quantitative easing in the 2010s, which, as far as I'm concerned, is kind of toothpaste out of the tube. The reason the Fed has had difficulty in the past winding down the balance sheet has been that it's kind of led to issues in liquidity in treasury markets. I'm thinking like fall 2019 type issues. And so I'm wondering how you think personally about the trade-off between widening down the size of the balance sheet and maintaining liquidity in these types of markets and being able to aggressively intervene in a crisis, and whether you think that's a tension or a trade-off the Fed faces or not.
Yeah. So look, I mean, I've spoken about this a fair amount. I think that the regulatory constraints that we've imposed on the banking system have created a demand for reserves, which thereby constrain our ability to set the balance sheet where we might others want to. And so, Tarek discussed fiscal dominance before. I've termed this regulatory dominance. We've created, the regulations force the banks to hold certain levels of reserves. Through liquidity regulations, there's additional supervision and enforcement practices that have tended to cause them to demand more reserves over time as well. And the result of that has been a demand for reserves that is driven by government policy and has therefore limited our ability in the past to reduce the balance sheet below a certain level. And so we've reduced balance sheet below a certain level, and then it leads to these short-term funding market stresses, which then leads us to stop reducing our balance sheet in reverse and then start expanding the balance sheet for reserve management purchases again. The net of that is that the balance sheet is not purely a monetary policy issue, it's also a regulatory policy issue. And the intersection of those can sometimes constrain our ability to operate how we want. Now, I think it's important, as you say, during a crisis to be able to engage aggressively and swiftly on liquidity issues and credit provisions and credit markets. I think that's all very important, and I think that will sort of continue to be the case. I've argued that it would be a good thing for us to resume reducing the balance sheet. I think that having a smaller monetary policy footprint is a good thing. I think that having the Fed step away from credit provision would, generally speaking, be a good thing as well. Credit provision is the wrong word. Having the Fed step away from being involved in the markets with a large balance sheet would be a good thing as well. But we're constraining our ability to do so because of the regulatory apparatus. My view is that even though it is a good thing to reduce the balance sheet further, before we can do so, there's a number of hoops we have to jump through that would require us to revisit some of the banking regulations that have grown over the last decade or so, over the last 15 years. that would reduce the regulatory demand for reserves and allow us to resume shrinking the balance sheet.
We have time for one last question.
It has to be the best one. Who's going to ask the best question?
Sorry. Just want to make sure there's nobody else.
Yeah, no,
Last one.
Sorry for the.
Going back to the discussion of U.S. debt, I think although maybe the numbers can be disputed, it is true that there's definitely revenue coming from tariffs and from the TGCA and Big Beautiful Bill from GDP increases. But I think my question is, I think also should be included in this question is the idea of like tax cuts, the revenue loss in tax cuts, and the increased spending from the Big Beautiful Bill. And how do you like take those all together when thinking about monetary policy as in the Fed?
Yeah, so there's no question about it. There's some that you want to include both outlays and revenues when you're thinking about the fiscal path. Now, the Federal Reserve, we don't set the fiscal path, right? The fiscal path is set by set by other parts of the government. But the fiscal path matters for what we do because it affects inflation, it affects the output gap, it affects the neutral interest rate. And I attempted to give a fulsome exposition of my views on these issues on a speech that I gave in September on non-monetary forces that affect monetary policy, because I do think it's one of the more important things that are out there that will sort of crisscross. But the net of it is what I was saying before, which is that I think that the combination of increased revenues from tariffs and increased revenues from better GDP growth are going to reduce net national borrowing, which then serves as a interest rate depressant through the channel of what we call the neutral interest rate in the United States.
Okay, thank you so much. Let's thank Stephen and Tarek for a great discussion.
Thank you.